Okay, I'll start all over. We have Allan Cameron, Financial Services Executive and Investment Advisor Representative with Strategic Financial Partners. He is a certified financial planner, and his goal is to assist his clients in making strategic financial decisions that will result in a financially secure lifestyle both now and in retirement. I could welcome Allan and give him your attention. Thank you.
Good morning. As I was standing in the back, I'm looking out thinking, gosh, what a great day to be in a meeting. And the flip side of that thought came to me is like, so we're in a meeting and it's gorgeous outside. How many people are paying attention to the speaker? Everybody's going, I want to be out there. Thank God it's a little bit overcast and rainy today. And I understand it's going to be that way all day. Anyway, thank you. It's a pleasure to be here. I'm here because I have worked with Terry's wife. I work with the University Health System as their financial advisor and have worked with the University of Tennessee for years doing these kinds of meetings and education. We're going to be talking today about retirement. I know everybody in here has a different retirement system, most likely. The state may be the most prevalent. We're not going to talk about the individual plans, except for a couple specifics that I'll mention later. But generally, we're just going to talk about the theory of investing for retirement and in retirement. As you were told, I'm a financial planner. I'm also an accredited fiduciary, and I've been doing this since 1992. I started as a financial advisor for the University of Tennessee, where I help people with their 401A plans, which is an optional retirement plan that professors can opt out of the state plan and into a plan with a company that allows them to invest and do a little bit better, hopefully, than the state retirement. Although I will tell you that hasn't been the case. The state retirement has been an awful strong plan for those of you that have it. This is amazingly timely. Has anybody paid attention to what's going on with the market the past 3 or 4 days? Yeah, it's been a fun roller coaster ride. Most of this year after February has been pretty much low volatility. Everything goes up. As of Wednesday, we saw a 600-point down day. A week and a half ago, we saw an 800-point down day. Yesterday, we saw a 400-point up day on the Dow. And today, we're probably going to see it get slammed because some big tech companies, Amazon and Google, reported unspectacular earnings. And they went on to say in the next 6 months, they don't see things getting better. And that's really the worst part of it. Is nobody, we're in the middle of earnings season right now. They're reported quarterly. Companies are coming out and saying they don't expect the next 6 months to be very good. And so the market is taking it on the chin. I'd be real curious to see where we end up. And one of the themes I'm going to tell you is timing is everything, but it's more important to be in the market. When we see this happen, this historically has always been a buying opportunity. You'll hear me come back to that a number of times. Does anybody know what a financial expert is? He's the guy who's going to know tomorrow why what he predicted yesterday didn't happen today. There are no crystal balls. What I hope to do is by the end, and you're financial people anyway for the most part, so you're going to get this, but be consistent, have a plan, don't have knee-jerk reactions to financial plans. Don't look and say, oh, the market is falling, I've got to get out. So right now, this is actually part of a larger plan. We would typically be talking about goals. If you're looking to build your retirement plan, we would then start talking about personal expenses and tax strategies to keep your money in your pocket and not in the government's pocket. We'll talk about accumulation, and retirement income planning is what we're going to focus on this meeting. And then typically in the fourth meeting, we would be talking about legacy and benefits, which could often be Medicare, Social Security, building a will. Today, we're going to focus on accumulation and talk a little bit about the idea of how the thought process changes when you get into retirement. A couple rules I want you to remember, and you can write these down, they're sort of fun. This is the rule of 72. The rule of 72 is great. It tells you why earning low interest is not a good thing, or I should say it shows you why it's not. You take 72, divide it by your interest rate, and that gives you the number of years for your money to double. So has anybody had money invested in a bank with a 1% CD or a 0.5% money market? Nobody?
None of us will admit it.
Well, just take that 1%, divide it into 72. 72 divided by 1% means it's going to take you 72 years for your money to double. As opposed to if you get market returns, the past 5 years, the market, the S&P 500 has returned right about 15% per year. Well, take and divide that into 72. All of a sudden, you get a much faster doubling. Just take 10%. 72 divided by 10 every 7.2 years. If you're getting a 10% return, your money is going to double. That's what I use to sort of govern how good an investment is and how good it's been historically. Now, of course, the catch is nobody knows what investments are going to do going forward. We know what they've done historically. And what I'm going to tell you now and again is it's being in the market that will keep you getting those better returns. The rule of 25 when you're planning for your retirement is your annual income times 25 is take that number and you can take 4% out of that per year for the rest of your life and have a very good retirement. So you're looking for this nest egg number. How can you build that? And that's what they're telling you. It's called the rule of 25. It's very simple, and what you're going to find when you go through the math is the annual income ends up being the nest egg number. Your income, when you're done 4% times the nest egg, it ends up being your annual income. And that's what you're trying to do, is replace your income in retirement. This goes through the math, and it takes and shows you, if you have a monthly income, $5,000 a month, $60,000 a year, $2,500 a month is through Social Security pensions, possibly. You have a $2,500 gap to fill. That's the number you're looking to replace, is the gap number. How much money do you need to fill that gap? Well, about $750,000 of assets at 4% will fill that $30,000 gap. Okay, so today, what we're going to talk about is the risks of investing, managing risks, getting invested, diversifying, staying invested, and balancing your portfolios are just strategic steps to make sure your portfolio is consistent and stays intact. Managing your risks, you've got to understand the risks that are in the marketplace. One of the things we just talked about a little bit is the CD. Low return, low risk means low return. High risk means a much better return if you have time on your side. I can't tell you that strongly enough. Time heals all wounds and heals all returns. We'll talk about that in a couple minutes when we get to the S&P 500 stock fund. The next one is inflation risk. Inflation, does anybody know that? That's the 85 Mustang. I don't know why, well, I know why they chose that, because 1985 was at the point when they were doing this roughly 35 years ago. But that was the ugliest Mustang they ever made. No wonder it was worth so little. As opposed to today's Mustang, which is now worth $335,000, almost $36,000. A little bit different price. And I tell you, if we could have bought that Mustang back in 1985 for $6,500, that would have been a buy. I don't think that was ever a buy, but that should be. Yogi Berra said a nickel ain't worth a dime anymore. I thought that was cute. And here's just some different choices for inflation to show you how it has changed. Postage stamps went up about 3 times since 1980. Cornflakes were a buy. What we should have done is bought just truckloads of cornflakes, and we could have resold them at 6 times. I'm not sure how good they would have been today. And of course, gasoline really, as a bargain, it's only doubled in price. So inflation, 2 ways to think about it. This is today's dollar, how it declines over 10 years, over 20 years, over 30 years. So a dollar would buy 31 cents in 30 years. Or the other way to think about it, the expenses rise. So today's dollar will become worth $1.49. You'll need $1.49 to buy the same thing in 10 years, $2.22 in 20 years, and $3.31. It's just looking at it 2 different ways. My purchasing power and the value of the dollar if I put it in a CD or bank account. So interest rate risk is what we are seeing happen today. It's one of the factors that's negatively impacting the market. The Fed is going to raise interest rates, possibly again. Right now, I saw there's a 78% chance they're going to raise rates in December. They raised them 3 times already this year. Today, the 10-year Treasury is somewhere around 3%. With the market falling, chances are that interest rate is going to fall because the value of the bonds will go up. The point to this slide is, as interest rates go up, the value of a bond that you purchased in the past, like last year, goes down proportionately. So if interest rates go up from 2% to 3%, the value of your bond goes down in an equal proportion, or around 1/3. So bonds can lose money. The other thing that you need to know is, as interest rates rise, money is attracted to interest-bearing accounts that can get the new interest rate, and so it slows the market down. This is volatility risk. You can see how lately, 2017, third quarter, second quarter, first quarter, pretty much no volatility. Look back here in 2008 and 9, how we had high volatility. That's really what's happening right now. We're going to see these kind of figures in the next, in 6 months, I'll be showing a figure that looks like that over here. This is my favorite slide. It's the S&P 500 is the green line. This is as of August 20th. The red line, you see 3 things going on here. The S&P 500, which is the United States stock market for all practical purposes. The red line, which is the Federal Reserve rate that is manipulated. It is the only thing that we control on that screen. And the blue line is the 10-year Treasury. The 10-year Treasury and the stock market are purchased. They're manipulated by people buying them. The Federal Reserve is manipulated by the Federal Reserve deciding to raise the interest rate or lower it. And it's what causes the other 2 lines to move. You're going to notice the red line moves first, the blue line follows it. And as interest rates are going up, this was 1962 through 1982, what happens to this? This is very mild. That slope of that line right there is not real big. Look what happens as interest rates start to go down. Well, money looks for the best place to get a return. As interest rates dropped, the stock market rose. By the way, that was Black Monday, 1987, October 19th, and October 26th of 1987. This was the tech boom and bust in March of 2000. That was 9/11 right there, that drop there. That was 2008 when we had the mortgage crisis, and we bottomed out in February of 2009. And since 2009, look at that slope right there. And now we're seeing something, right now it looks a little bit like that. If we were to see yesterday and today's moves, we're going to see something like that. It could end up being something more like this. That was 1974. That was Nixon, Watergate, and impeachment. Anyway, we could see one of these happen. I don't think we're going to see it be that big, and I think we're going to see it be more continuous. We're fighting 2 things right now that you need to be thinking about. We're fighting increased interest rates, which really are at the rate of everything, and a tariff war. The tariff war is causing the industrials to take it on the chin because they're having to charge more, and their earnings are going to be less because they're getting taxed on their products overseas. So all that to say, this is a buying opportunity, that is a buying opportunity, that was a buying opportunity. If we see a big fall, it's a buying opportunity. Now, one thing that happens with most plans, if you're a governmental entity or governmental worker, you have a 457 plan. If you're a public worker, you may have a 457 or a 401k or a 403b. They all work exactly the same. And the benefit to them is you get to dollar cost average your money in. Every time you get a paycheck, when these things occur, don't pull your money out and save it. Take investing, because each time it goes in, sorry, wrong button. Each time it goes in, you buy in $1, you get a better value on your dollar. When it does go back up, you won. Now what that does is that gives you an average that goes right along through the middle of this, and you average down. It's called dollar cost averaging. We'll talk a little bit more about that. Don't pay the cost of waiting. At 9 months, baby says it's too late for me. It's never too late. Start now. Yes, I wish everybody had started back when they first started working. We didn't do that. I didn't do that. Just take advantage of it. I thought that was a cute slide. This shows you what happens if you wait. This is somebody who invests the first 10 years they work. They only put in $5,000 or $50,000 a year. The value at the end of 30 years is $225,000 essentially. The procrastinator waited the first 10 years because they had a college loan, they had to buy clothes, they had to buy a new car. They put in $5,000 a year for the next 20 years, which is $100,000 in investment. They still only have not $195,000, which is roughly $30,000 less than what this person has, who put in less and has more. Money has value over time. And what you're seeing there is the time value of compounding interest and the money making money for itself, as opposed to you working for it and trying to save it all yourself. That's why when you have opportunities like this, buy into the market. Different ways to invest: foundation money, savings, money markets, conservative investments, stocks, growth, and then alternatives. Anybody invest in collectibles of any kind? Dolls, stamps, coins? No? Good. Now, gold is not an investable. Gold is a precious metal, and that's a good investment. My mother happens to invest in dolls. Actually, her mother invested in dolls, so she inherited dolls. And now she said, can you sell those dolls for me? I'm 92, I don't use them much, I just need to get rid of them. We tried to put them out there, and you've got to find the right buyer. We haven't sold the one. And we were told how valuable these wonderful dolls were. So if you know of a doll collector who's looking for a doll, let me know. Foundation investments, CDs, money markets, stuff that's in your bank. This is money that's good for short term, that you're not trying to make anything off of, that you just want there for safety. So if you need to have 3 to 6 months of living expenses, you got it. You're protected. You're not going to take a tax hit to pull it out. You're not going to take a penalty to pull it out. You have your money there, cash on hand. Conservative investments are generally considered to be bonds. I think that if you go back to that chart that we just saw back here, I am concerned that people don't understand that as bond interest rates go up, it's going to drag the market down a little bit, but the interest rates going up is making the older bonds less valuable. So if you have a bond fund, as interest rates rise, you're going to lose money. We haven't seen that happen literally in 35 years. And it's going to change the feeling on this slide, because people think you can't lose money in bonds, and I'm here to tell you, you can lose money in bonds. Bond funds specifically, because bond funds have to pay redemptions, and when people redeem their bonds, their bond funds out of mutual funds, the fund takes a hit. It has to sell its older bonds. Does that make sense? The benefit to bonds is if you go out and buy a bond today, and it pays you 3%, and you put $1,000 in, you're going to get $30 for the next 10 years, guaranteed, and you'll get your $1,000 back. That's why people say you can't lose money in bonds. However, if you have to sell that bond early and interest rates have gone up, you have to take a proportional decrease in the value of that investment. So if interest rates go up to 4%, you're going to take a 25% hit on your bond. It's only going to get you $750. That makes sense? Equities, I'm going to tell you, people used to go by the 100-year rule. They take 100 years, subtract their age from 100, and that's how much money they should have invested in stocks. And the idea being, as you get older, you have less and less money in stocks. Statistically, you should have about 60% invested in stocks and 40% in bonds and cash through your retirement savings career. That means you should never be completely out of stocks. If you are, you're going to lose money to inflation and taxes. Precious metals, art, and real estate. Real estate, you know, I guess no matter where you are, I used to think I wanted to go to Destin and have a place on the beach. I'm not sure after the hurricanes keep hitting if I want a beach place. I'm betting that beach property is taking a bit of a hit. At the same time, 10 years ago, in 2018, you could go buy a mountain cabin pretty cheap. Today, they've gone up to full price again, and maybe more. So it depends on where and when you buy, but generally real estate is thought of as a good investment. It is an alternative investment. It's not something that's invested with any type of protection other than the fact that you own the title. So the effect of taxes on your investments is another thing. Anything that's done short-term, less than 12 months, this is generally considered stocks. Sold for a profit within 12 months, you're going to pay regular income taxes on. However, long-term capital gains, at 13 months or 12 months and a day, reduce your taxes that you'll pay to a maximum rate of 20% today. Dividends, for those of you who have dividend stocks, and stocks like the S&P 500 will produce dividends for you, they will be also taxed at a maximum tax rate of 20%, unless you have certain earnings, like you make more than $600,000 a year. Then you can be taxed at ordinary income. They can reduce your investment, which is why you want to take advantage of your 401k, 457, 403b. A diversified portfolio, be diverse in the portfolios that you make up. You shouldn't ever be all in one S&P 500 fund or all in one stock. Have a little bit of everything. It protects you when we have markets happening like we have to do today. Science and technology is going to take it on the chin today if it hadn't already. I guess it hasn't. We're still before 9 o'clock, aren't we? So we're going to see it be ugly. Being in the market is 90% about the allocation and only about 7% of the specific investment. Looking for that best stock, best mutual fund that you've got to have. It doesn't matter. It doesn't matter if that's the best performing mutual fund. Mutual funds in the same class all perform alike. These are the style boxes. When you're looking for your investments, try to have something in value, something in growth. You can do the middle boxes, which is just a blend. With the large cap, mid cap, and small cap, those all move pretty distinctly as a group. Large stocks move like large stocks move. They're much safer generally. Small stocks move very aggressively in both directions, both up and down. This is considered the periodic table of investments. What you're going to see here, if they showed you the Russell 2000, how it goes all over the place. The Russell 2000 is small cap stocks, 2,000 small cap stocks. You probably know the names of some of them, but not many. I'm going to show you the S&P 500. That by far is what I consider to be the bedrock fund for everybody to be in. Invest something in the S&P 500 and then add other things around it. But that is the largest 500 companies in the United States. It is tracked every day by every broadcast news publication. Notice S&P, it just goes pretty much right down the middle. There it is. There it is. You won't see it move a whole lot. It just stays right in the middle, right in this section here. And the benefit to it, those 2 years, in 14 and 15, large cap stocks really did well. The benefit to the S&P 500 is it's average most of the time. Low expenses, average returns, but that means if there's 10 funds it's competing against, it outperforms 5 of them. And it does that year in and year out. So when you get to a 10-year return, it's in the top 10% of mutual fund performances because the expenses are so low. Does that make sense? This is our breakdown. Tells you everything you wanted to know about each of those boxes. This discusses diversifying with mutual funds, growth, income. There are socially responsible funds. I'm going to tell you socially responsible funds take all the fun out. But the socially responsible fund will go in, for instance, you'll lose Diageo or Constellation brands that make alcohol. You'll lose Altria. Guess what in the down market are the best performers? The sin stocks. People smoke more and they drink more when the market falls. Yeah. So you just, honest to God. So when you take and remove those from your portfolio, you're pushing yourself further down when the market falls. So I'm going to tell you, I'm not a fan of socially responsible. It's okay, you know. I was going to say my mother's a tree hugger, but I like trees a whole lot, but I want my portfolio to do well. Tax-free, there are tax-free mutual funds. Generally, you better have a sizable income to be involved in tax-free. It's not worth losing the return to be in a tax-free investment unless you have a huge tax burden. Index funds. Each one of those boxes back in the right here, Russell 2000, S&P 500, there's an S&P 400, there is the MSCI, that's the World Index International. Each one of those has an index that will follow just that fund. Index funds are simply following the calculation every day. They literally invest in the same stocks that make up the S&P 500. Vanguard Index Admiral Fund is the first one that I can think of. It costs 4 basis points of management fees. That's it. There's no loads, 4 basis points. Put that in simple terms, that's 4 pennies on $100 invested. As opposed to many mutual funds will charge up to 3% or $3 for every $100 invested. And they have to make that up and then some to catch up with that Vanguard Index 500. Sales charges. Investing in mutual fund is going to carry sales charges. In your retirement plans, there should be no sales charges or loads. 401k, the state Empower plan, if you have an option for the state Empower 401k or 457, that's a great plan to be in. You're not going to see any loads and very low expenses. The state manages that plan to keep the expenses down. If you go to an individual 403b that's in many public school systems, that's an insurance product that will have generally very high expenses. And you can find that just by going and looking at the company's S&P 500 and see the difference between the 401k's 500 and the 403b's 500. Same index, same management. One will have 2 to 3 percentage points less return. And that's because that's going in fees to the company. Turnover is what you want to look at also. I'll tell you, an S&P 500 fund has about a 2 percentage point turnover every year. That means that means roughly 8 to 10 companies get kicked out of the fund and replaced with 8 to 10 other companies, as opposed to some small cap funds that may have as much as a 300% turnover. That means basically every fund has been replaced every 4 months. I know Putnam over-the-counter fund used to have that kind of turnover, and what that means is that's a lot of trading, that's a lot of expense, that's a very high internal fee. Expense ratios, 12B1 fees, those are sales charges. 403B would have those. Your 401k mutual funds have them, but generally the state has gone through and found the lowest expense funds they can find. And just the investment policy, how much money does the mutual fund have on hand? Most people won't know that. It's going to be hidden in the prospectus. It's really more important to look at the asset allocation. Where is the fund investing, and is it investing like it should, than the cash on hand? Although cash on hand means if we have something happen today, like we probably will, they have the opportunity to buy in on a down cycle. These, we have to keep lawyers employed, meaning lawyers in the room. We like to keep you busy. This is a risk tolerance questionnaire. I'm going to tell you, we can talk all day long about how to invest and investing more aggressively for retirement, but if you can't sleep at night because your investments are all over the place, don't do it. This just helps people out. You have basically looking at portfolio A. Would I take $100,000? Would I mind losing $5,000 to make 10? So my range would be 95,000 up to 110. Or portfolio G, would I mind losing 24,000 to make, what's that, 49? So that would basically look at 76 to $149,000 spread. How comfortable would I be with that portfolio? I might be fine with it. You might not like it. But I'll tell you, over time, that portfolio will come out ahead. And when I say time, I'm talking 10 years. If you're less than 10 years away from retirement, you want to start becoming more conservative. If you're 15 or 20 years away from retirement, somebody who's starting in business world today needs to be everything all in stocks. Somebody who's 55 looking to retire at 60 may want to be looking at something more like that. Just to protect yourself, because you need to make sure money is there when you need it. These are just different versions of a conservative portfolio, a moderate portfolio, and an aggressive portfolio. And you can see the conservative portfolio has a lot of cash and bonds. The aggressive portfolio has no cash and bonds. It's all invested in stock. This is somebody who is possibly retiring. I would tell you I would be 60-40. I wouldn't be as heavy as they are conservative, but that's me personally. That's where your own personal risk tolerance comes in. Another way to look at risk allocation, U.S. equities, international equities, fixed income. These are bonds, international bonds, and any cash equivalents. Very safe, risky depending on the country. United States bonds are considered the safest investment in the world. That is because they are backed by the full faith and credit of the United States government. You have 10, 20, and 30-year versions of those bonds. They have never failed to pay out. If you go down to Argentina, which would be an international bond, or Italy, more recently Italy, they're defaulting on their bond payments. That means if you have a bond with them, you're not getting your interest paid. So there are some countries that can default. The United States has never defaulted. So far, if they do, all they do is add a little more tax to us and we pay it. But it is possible that it could happen someday, hopefully never. International equities, very volatile ride. What they say is stocks are the value of knowledge. That is, if you know everything about the stock, you can make a good investment with it. The United States stock market, pretty much you go to GM, there's analysts, there's probably 40 analysts that watch General Motors. If you go to some international country, and if you go to Italy, there may be no analysts. It may be a very high crime rate. There may be a lot of extortion. You don't know what that company's involved with, but there's a huge opportunity for growth if you can find the right company. But our markets are generally considered to be about as safe as you can get. So you have the investment buckets for investments, and then you have the risk levels. Liquidity risk is directly related to cash. Volatility risk is related to any of these. Volatility risk is what we're seeing happen today. Interest rate risk generally has to do with bonds. Inflation risk has to do with pretty much these three. Cash is at risk of inflation. US equities generally keep up with inflation. And then market risk is just being, technology is going to fall today. That's being in the technology market. That's going to take it on the chin. So these are different risk levels, and these are the investments and how you can diversify those investments to make sure you reduce the risk down here. As we talked a little bit about, always have some money on hand, 3 to 6 months of cash, and any type of emergency expense that you may need. This is usually, I suggest people buy a car. If you get done making your payments, continue making your payments to the bank for yourself. So the next time you can take and then buy the car cash. Well, that's an intermediate term investment. And then you have the aggressive investments, which are basically retirement. Your retirement should be your longest term investment, the one that you invest the most aggressively. Other things to look at, are they taxable? Money you put in the bank is taxable. Money you put in your 401k, 403b traditional IRA is pre-tax and will only get taxed when drawn. That's called tax deferred. And then tax-free investments are going to be something like a Roth IRA. They say municipal bonds are tax-free. I'm going to tell you, you just paid the tax on the money before you put it in the bond and before you put it in the Roth. Stay invested. It's time in the market. Today, if you invested that market going from 97 to 17, $10,000 over a 20-year period, and just stayed in the market for 20 years, that $10,000 basically quadrupled to $39,800. If you pulled your money out just before the top 5 days, you would have a third less at $26,000. If you missed the top 15 days, you would have $15,000. And if you missed the top 25 days, you really made $50 in 20 years. Stay in the market. Don't let these short-term fluctuations bother you. Here's what people do. Everybody thinks they can beat the market. So we're seeing the market go up like we have been. I had a client 3 weeks ago who called up. She works at the hospital. Allan, I'm just making 1% on my CD, and I'm saying, now's not the time to buy in. Let's wait and see. There's going to be a pullback. I promise you there'll be a pullback. There always is. We've had 10 years of good luck, and we've got to regress to the mean. So, well, let me go ahead and put some money in. Well, it's her decision. So we moved about 25%, and we're right here. We're past this point. So now we're falling, and I told her, now we want to start talking about getting in. And I think even now it's too early. I would start buying in with your dollar cost averaging But I would stay, right now, I think we're here, and I think we'll see a whole lot more, because if the Fed does not raise rates in December, I'll be a whole lot happier about the market next year. If they raise rates in December, I'm afraid we're gonna have a real rough year. And that's personal. That and my crystal ball will buy you a cup of coffee. So, but typically an investor buys here, they get really excited, I'm missing out, I'm missing out, I'm missing out. Oh, thank God, I'm in now. Oh, this is great. Oh, well, I'm starting to lose money. As it goes down, I've got to get out. I can't take any more pain. The market bottoms out, and then we start over and do the whole thing again. Oh, I'm going to get back in. I'm missing out. I'm missing out. You can almost see it happen. I mean, I've done it. It's not something that everybody here, I'm not immune to it. It's hard to watch the market go up and feel like you're being left out. It's awful fun to watch the market fall and realize I've got some money over on the side. I'll just wait. Even then, it's like, gosh, when do I put it in? And that's why just regular objective investing is a whole lot easier on you. It's a whole lot better to sleep with. It's also a whole lot more consistent. You can't second guess the market because nobody knows what's going to happen. And when people do get out, it pushes the market down further. You can literally see it happen. The market, people getting out, I better get out. They push it down even further. It starts going up, and ooh, this right there is the general public starting to get back into the market. It pulls out, and then everybody freaks out, and then we do it a little bit here, a little bit there. That really was computerized trading. Today, what we're seeing is actually going to be computerized trading. Everybody has these algorithms and computers that do the trading for them. The market is going to hit certain levels, and when it hits that level, the computer kicks in and says, oh, we got to sell everything in that position now. And of course, what that does is that makes it go down faster and farther. And so at some point, maybe beginning of next week, we're going to see some bargain buyers come in and try to take advantage of the weakness. So you'll see the market pop back up like we did yesterday. And I'm afraid it's going to continue to fall back down after that. But that's why it's never up in a straight line and never down in a straight line, because people are always trying to second guess when the top is and when the bottom is. Because everybody wants to get in at the top and the bottom. Very few people actually do. This is talking about the dollar cost averaging. Every month, let's just say $500 is put in, but the share price changes. In January, it's $10 a share, so you bought 50 shares. In February, you bought 55. In March, you bought 62. It goes down, it comes back up. What happened to you? You bought 273 shares with $2,500. If you bought everything in January at $10 a share, you'd have bought $2,500, 2,500 shares, 250 shares. I will get the numbers right eventually. And you would have a $10 average share price, which is where you are today. Here, you actually made money because when the market fell, you bought in on sale. Periodic adjustments are helped if once you get a portfolio together that you like. Generally, rebalancing is considered to be every year where you take money from your winners and move it to your losers to keep yourself at the same portfolio diversification. That is, if you don't, you're going to end up with a portfolio that's going to have more of one stock or one mutual fund than it does of the other proportionally to where you wanted it. And what this does is it forces you literally to sell off your winner and buy into your loser and reallocate it back to the original portfolio. That is a winning strategy in the long run. Most companies offer that as an automatic service where you can have it done every year on your anniversary. You can have it done every year on January 1st, whatever day you want. It's just simply a computerized program. So today, we're going to be a little ahead of time. Risk and reward go hand in hand. Diversification, oops, wrong one. Attempts to minimize the effect of volatility. Time in the market, that is, stay in the market. Time horizon, the longer you have, the more aggressive you can afford to be. Recognize risk and find ways to manage them. It can be just as important as choosing the right investments. And with that, we're going to talk about just when you get ready to retire and start pulling out your retirement income stream, you can't afford to be aggressively invested like you were going back to time horizon. When you're living on that money, the one thing I want to say about taking income out When you're taking out 4% and the market falls 20%, all of a sudden you're taking out 5%, not just 4 out, because you now have less funds. So you've got to plan on having cash over on the side. So when the market falls, if you're withdrawing from this account, you have something to offset the losses with. And that's what's happening. I'll tell you, I had a client about 4 years ago now. Her husband had a 401k. He'd listened to one of these radio talk show hosts, and he had $4,000, and they were pulling it out $40,000 a year, 10%. That was the recommended rule of thumb. You can take 10% out. 10% drained that account. They were down when he passed away. She came to me with $225,000, said, I need to pull $40,000 a year out. Well, all of a sudden, that's almost 20% of her account value. That was only going to last her another 4 years. And I said, you just can't do it. And she said, well, I've got to. And I think she's now living with her son, because she pretty much took everything out and living off Social Security now. Now, she had a good savings, but she just over withdrew. On your table, you've been given a couple pieces of paper. One is just age-based tips for retirement, some things to think about when you're getting ready to retire. It talks about the basic landmarks. At 50, you could start making additional contributions to a 401k, an IRA, or most retirement plans. At 55, you can start taking a penalty-free tax withdrawal from your 401k and your 403b. At 59 and a half, your IRA can come out penalty-free. 62, you can start taking Social Security. Don't. You get penalized twice by taking it early. At 65, Medicare kicks in. Go to Social Security office or go on Medicare.gov, better yet, and make sure you enroll before you turn 65 for Medicare, even if you're still working. If you don't, you may have a penalty. So make sure you enroll in Medicare before you turn 65. 67 for anybody born after 1960 is the new full retirement age. And at 70 and a half, you're going to start taking out a required minimum distribution for any qualified retirement plan, a 401k, a 403b, an IRA. And this is just a roadmap to retirement. Just a little bit about sort of things to look at, maybe help you think through a retirement plan. And then also I left a feedback sheet for you. If you would just complete it, what you thought, and love to pick those up or have them. Ladies, can you just take the feedback? If you would like to be contacted, I am local. I do East Tennessee. I have an office in Kingsport and an office in Knoxville. I'd be more than happy to sit down with anyone on an individual basis and just discuss investments and retirement. Not a problem. Terry, thank you for having me. I hope you all enjoy being inside. Well, it looks like that outside.
Question.
Sure, I'm sorry. Are there any questions? No, thank you. I didn't mean to interrupt the applause.